Good morning, everyone. Welcome to this update for global stocks and commodities for the 8th of April. A shortened week in Australia, a normal week in the US, 5 sessions, but it was another very, very choppy week. We started the week poorly with a significant decline. We finished the week with a significant decline, and we had some strong days during the week. So net the US lost ground, but it was certainly by no means just all in the one direction. So let's have a look at what's actually going on. I want to have a look at the market, obviously, in terms of the indications we're getting at the moment about where a base may be. I want to take a look at the FAANG stocks as well as looking at the indices and see what we can determine from that. And of course, the normal commodity trend update as well. Portfolio analyst last week was quite a well received session. I was looking at a recap on some of my favourite Australian and US growth stocks, and also went into quite a bit of detail on US sector analysis as well. Just a perspective on the trade dispute, because that's obviously what's driving markets at the moment, and it's where all the fear is coming from, the uncertainty. People just don't know how this is going to play out. Personally, I think this is a situation of some of the major players are taking advantage of all this and are actually having a lovely time trading the market up and down. This really does look like a lot of programmed buying and selling to me. But with respect to the trade dispute, it's really about a much bigger picture if you step back and look at what is actually driving this. And over the last multiple decades, there's really been a loss of global leadership by Europe, Japan, and the US. And that leadership is now being taken up by the developing world, which obviously includes China and Asia, but also other areas as well, in terms of, perhaps South American countries as well. And all of the incredible implications that go with that, and India, of course. And that is one of the key big picture reasons that we're seeing so much stress in the global system at the moment, and not just the financial system. I think it's part of the reason that we're seeing this rise of populism all around the world. Up until now, the West has just let it go through to the keeper. They haven't really done too much about it. And now Trump has come in with his own unique style, if you want to call it a style at all. And he's putting his finger on the issue that everybody knew was there, but was really incapable of doing much about. The US trade deficit has now grown to be really at an incredible extreme. And 50% of that deficit is with China. But look, the Americans have got a point on a couple of areas. Certainly, I think most commentators would agree that on the steel side of things, that China has been dumping steel on the world stage, and something really needed to be done about that. But the Americans have really got a point with respect to the requirement for them to give away a lot of their IP in order to be able to do business in China is clearly pretty unfair as well. And finally, Trump has called a halt to that. And who knows? Maybe this is the only way to negotiate your way through this. But certainly doing it by tweeting is not something that the market expected. I think the Chinese are being quite astute. The tariffs that they're imposing or talking about imposing are far, far less in magnitude than the Americans, but they're very, very targeted. And they're targeted in industry sectors that are really Trump's voter heartland. And so they're trying to cut Trump off at the knees by really targeting his supporter base. And that's pretty clever. The other thing that's really obvious too is that US consumers are going to be hurt far more by these trade tariffs if they actually went through with them than US businesses are going to benefit. And as many of those consumers are Trump supporters, irrespective of what you may think about Trump, he's not stupid. And I just find it very hard to believe that they're going to go through with this. I think this is a lot of posturing, and there'll be a negotiated settlement. So that's the likely outcome. It's going to take quite a while. It'll probably take all this year and maybe next year as well. But at the end of the day, and I've said this many times with respect to the market, self-interest of the major players always prevails. And in this case, the self-interest of the Trump administration, I think, will prevail. If they go through with this, they're just cutting their own throat. So I don't believe that's going to happen, and I believe the market is anticipating a trade war that's probably never going to eventuate. But nevertheless, the market will keep overreacting in both directions, and that's certainly going to keep investors on their toes this year. But look, I see it as good news, really, because it means that if you're very clear about what you're doing and what stocks you are looking to buy and roughly what prices you want to buy them at, then you're going to be able to buy them a lot cheaper than they were trading at last year. So I think all this activity is generally a positive if you know how to play it. Now, the worst case scenario is that everybody throws their brains out the window and goes through with this, and we end up with a full-on trade war. Just can't see it happening. But if that were the case, then global growth would slow, and it would probably slow significantly, and that would just be bad news for everybody. And it certainly would be bad news for the stock market. Inflation would rise, and that's going to push up interest rates at a faster pace, and that, of course, is never good for stocks. The interest rate rising cycle that we've got at the moment, whilst it's in its early year or two, is generally a positive for the stock market because interest rates are going up because things are going well. It's when you get into the later stages of that cycle that becomes bad news for stocks. Of course, significantly rising interest rates would really cause all the chickens to come home to roost on all of that debt that exists out there, and it would cause a massive problem. And I think that would be a problem that was significantly greater than the GFC. So, that's the look over the cliff, and that's why I don't believe that we're going to see a full-on global trade war, because it's just going to kill it for everybody. Australia, of course, would be affected probably worse than most because of exports to China. So it wouldn't be good for us at all. Let's look at American stocks. The index was lower by 1.4% across the week. Big declines on Monday and Friday, and some nice, useful gains in the middle. I believe that earnings season, which starts soon, will be probably a pretty good one, because for the first time in many years, American corporates have been raising their guidance, and that's something we haven't seen for quite a long time. They're generally extremely cautious. The game they play is to understate their earnings expectations and then beat them, and everybody cheers and the market price goes up. They're feeling so confident about things that they've actually been raising their estimates. So I think earnings season will probably turn out to be a good one. There's certainly no reason to expect that it won't be. And I think that will get the market focused away from this trade negotiation and get it focused back on the fundamentals. And I think that'll be good for the stock market. The US dollar was flat on the week. No change there. So let's jump in and take a look at some stocks. And I'll start first of all with the Nasdaq ETF. So this is QQQ. And you'll notice that we're still, despite all the volatility and despite the downside and the heavy selling in stocks like Facebook, the Nasdaq, or the QQQ, is still trading above its 200-day moving average, and the 200-day moving average is still rising at the same rate, maybe tailing off just a fraction at this stage. But you've got to say that is still a very, very positive orientation, albeit you can see there's been a huge amount of volatility increase in in the last couple of months since the start of February when this correction started. But let's jump in and just take a look at some of the key components of the Nasdaq. So this is Facebook, and of course everybody knows the well publicized issues around Facebook, and you can see that we've broken the February lows quite clearly. So there's the February low there. We're now well and truly below the 200-day moving average, and you can see the massive increase in volume. That volume is, on average, is more than double, and the peaks are just about quadruple the previous volumes that we saw. So Facebook being hit very hard, and you would have to say that the bias is now very much to the downside. So I believe we're going to see Facebook work its way down towards the 120 mark over a period of time. I think their business model is now being brought into question, whether advertisers will continue to support them as they have in the past. So I think there's a pretty good chance that Facebook is going to continue to the downside. So bear that in mind, a significant break of the 200-day moving average and also the February lows. Now look at Amazon. Amazon is still miles above the 200-day moving average. Yes, there's been a little bit of selling, but we're still above the February lows. So that was the little spike there. So still comfortably above it and only just below the 50-day moving average. Yes, the volumes have gone up a little bit, but this is a far, far better picture than many other tech stocks. The point of going through this exercise is that if there is a significant selling in the FAANG stocks, if institutions have decided that they are going to significantly reduce their holdings in the FAANG stocks, then that's not going to be good for the market indices at all, because they make up such a significant impact on the index. Next is Google. You'll notice Google not traveling quite as well as Amazon, but at this stage we're just level with the February lows and still basically level with the 200-day moving average. Again, there's been a rise in volumes, so we certainly are getting some selling off the peaks. So significant selling off the peak here in February, which is really a sign that the institutions are getting out in a big way. This is not a sign that the mums and dads are getting out. That occurs when you see, significant volume after 4 or 5 days down. The institutions are doing the big selling up here. Again, big volume off the peak, so not looking nearly as good as Amazon, but still not too bad. Let's look at Apple. Apple is pretty much similar to the Amazon chart, still well above the February low, still above the 200-day moving average, and not a particular increase in volume, particularly in this last little run down. So Apple stock looking fairly secure. And finally, Netflix. Netflix also is significantly above its February low. It's only just a touch below its 50-day moving average. In fact, you'd have to say that Netflix is the strongest of the FAANG stocks. So no real issue there. So I'm not really, other than Facebook, and there's specific reasons for Facebook, I'm not really seeing the sort of action in the really big stocks that indicate that the market's experiencing some selling from the major players. Let's look at the S&P, and that's why I think a good earnings season is going to turn that around. There's the S&P still clinging above the 200-day moving average, but we're not getting much of a bounce here. Yes, we had a couple of solid up days on Tuesday, Wednesday, and Thursday, but then it turned down again very sharply on Friday. So I would have expected to see a bit more of a bounce. So I wouldn't rule out some lower prices on the S&P at this stage. In the absence of a bounce, I think that becomes more and more likely. Now the Russell 2000 is also holding up really well, which is a positive. So you can see we're right up near the 200-day. We've had a little look underneath the 200-day, but it's still rising. So we're not seeing any drama in the Russell 2000 small caps. We're not seeing that much of an impact on the advanced decline line. So, generally I'm just not seeing, outside of some specific stocks. There was some heavy selling in Tesla, but those are for specific reasons. I'm just not seeing signs that this market's going to suddenly fall apart. The Aussie stocks now, the Aussie dollar steady at 76.8. Our index gained 0.5% for the week, but the futures market on Friday night erased all that gain. So if those futures hold into Monday morning, we'll see all those gains disappear on the ASX 200. Precious metals, gold was higher by $8, so there's not a lot of movement there. I'm not going to worry about showing those charts because they're just unchanged from what they've been for the last 12 months or so. So gold higher by $8, and it's really just currency movement, and GDX did nothing either. Copper edged up a little bit to 305. And it's for the bullish case to stay intact for copper, and of course that is also a real indicator for global economic health, then we need to stay above $3, and it's flirting with the $3 a little bit dangerously. I'm a bit surprised that copper, given the US dollar has been off the boil, I'm surprised that copper is not stronger than it is. Now crude oil came back again a little bit to 62.06. But this time, stocks went up. Not a great deal, but at least they went up. And that's a bit different to what we've seen in recent weeks. So let's just take a look at that particular chart. We'll look at the XLE. So just a little bit of positive movement on the week, on a week when the oil price fell. So we seem to be forming a base here in energy, and I wouldn't be doing much in energy until we actually see some positive move to the upside, but it's certainly looking a little bit more resilient than it did a short while ago. So that divergence is certainly worth watching. There's the spot copper chart, so continuing to hold above $3, which it's been doing now since October last year. And there's the crude oil chart, having backed off a double top around $66. So it's still a time to watch and wait. It's an extremely tricky market to try and trade short term. I think you're just guessing really when you see the sort of volatility that we had last week, 2% down at the start of the week and the end of the week, and then some significant up days in the middle. Just let the market find a base. Focus on good quality assets because they'll bounce back quickly enough, and there's some good bargains setting up. Corrections are always great opportunities. And portfolio analysts this week, I just continue to look for buying setups because this is the sort of environment where it throws up some great opportunities. There's my contact details for those that aren't members, and I'll be back with you next weekend. Cheers.